if Bitcoin stays decentralized and secure, which is basically, so we're 16 years in this technology. It's been tested in multiple ways. It's very anti-fragile, but it's not necessarily invincible. So to the extent that Bitcoin as a network is not kind of corrupted, captured, neutered in some way, as long as it just kind of keeps functioning the way it has been, I expect it to keep taking market share up to a very high level, because it's as fast as fiat currency, but harder than gold, as long as, again, it continues to operate the way we expect it to. And so I do think that eventually it does eat into major nation state seigniorage. Whether it's 100%, like it just completely invalidates the existence of fiat currency, or if it takes like half of it away, by basically constraining them more, by giving them a much faster alternative that people can go to. That remains to be seen. We already, the closest thing we have today is like dollarization. So if a country just manages its currency terribly, people dollarize from the bottom up. They find ways to get dollars and other assets, and everyone learns you just can't hold currency and bonds of this country. And so that country massively loses a lot of its seigniorage. And then extreme examples, the nation state itself will give up and just say, okay, we're gonna use the dollar as our currency. That's happened to a handful. And Bitcoin can do that to stronger currencies over time when it's bigger and more liquid. So we have a model in place, and we have this kind of long-term incentive to. There's really no reason to hold currency or bonds other than either one as the near-term working capital, like your checking account, basically to kind of pay bills in the current fiat era. It's like a hot potato. You use fiat currency, but don't really hold fiat currency. Or if you're a trader, sometimes, it's a volatility reduction. That's why it's still useful, because it's stable, at least developed market currencies. So if you want to reduce volatility, it can be useful. But for the most part, it's not that useful. And as Bitcoin gets bigger and less volatile, it keeps eating into the reasons why you'd ever want to hold fiat currency for more than just a couple months worth of capital. Yeah, I mean, entities like the US and China have more runway than, country XYZ that's a tenth of the size and more externally vulnerable. But the longer this goes on, the more indebted these sovereigns get, and the less kind of reliable the currency is. And then the longer Bitcoin's around and trusted and understood, then the memes start writing themselves. Like, it just becomes understood that holding bonds and currency for the long run is stupid. And you have to hold scarcer things. And then it becomes, okay, what is the best scarce thing to hold? Gold's an option. It's a good option. Equities are an option, depending on what country you're in, what access you have, and what their current valuations are. And Bitcoin is so far an amazing option. And so I think those things will eat into currency and bonds. And Bitcoin has the additional advantage, unlike equities and gold, that it can be used for money in the digital age.
It's so weird, and even like in some sort of magic trick that happened here, that at some point government debt became really an asset, so to say, and now then obviously got this reserve status. And so I don't know if you have any thoughts on this, because it also feels like to us who have grown up in this system, it's just ever going to be like this, but it's just amazing that this could happen in the first place.
Yeah, and I think, again, a big chunk of why I think it happened is because of the speed mismatch. So basically the world became able to send IOUs around the world instantly. Gold was still very slow, so they levered it 20 to 1, basically. And then they just kind of dropped it entirely. And people went along with it. And even today, when currencies fail, people generally dollarize. They don't start trading around gold and silver as frequently. In extreme examples, they do, like Venezuela, they'll use a combination of dollars, local currency from neighboring countries, flick little pieces of gold and silver. They'll use kind of whatever they can in extreme environments. But basically, it's just not solving a fundamental problem for them, gold and silver. And so people want the speed of other things. So I think that's kind of the technological era that we're in, as weird as it is. The example I like to use sometimes is when people invented farming, and we transitioned from hunter-gatherers to farming in cities. Most evidence indicates that the average life expectancy went down. So there's a trade-off that the ones that were like farming, they had more overall power because their numbers were incredible and they could just displace the hunter gatherers, and they were able to, some of the people were able to start working on tools full time, and then technology kind of started building very quickly. So the civilization got a lot of power, but for the average individual, like their teeth were rotting, they were just not as healthy. They were now crammed together and getting disease in a way they didn't before as frequently. And so it actually was like a lower quality of life. And this lasted for like thousands of years until they, discovered hydrocarbons and use it to make like running water and like and electricity, and then like, basic medicines and germ theory. And then they kind of got out of that slump, that multi-thousand year slump, and they actually got life expectancies kind of really, really high, higher than they were in the hunter-gatherer era. And I think we're in that kind of valley now, where when you get something that comes before something else, if you invent farming before you invent running water, you're going to have a rough time for a while, even though it's like a thing you have to kind of go through. And when you invent fast transactions with the telegraph, but you don't have fast settlement until Bitcoin a century and a half later, you're going to have a problem. And you solved one problem, but you invented another for yourself. That's the world we live in. And even though Bitcoin exists now, like I said, when it's under a $2 trillion, market cap or so, it's still in the nation state's court. It's still the central bank's court right now. So it's still, until it becomes so big that it actually rivals the size of that existing system, we're still in that era where most people are on a fiat standard. And so we're in that kind of valley. And so in that valley, things can seem unintuitive, like people living shorter lives than their hunter-gatherer counterparts, despite having ostensibly better technology. And today, it's like, why are we using government debt as assets? Well, because we're in this weird valley of time where they can justify it.
It's fascinating that today, like stuff like a Bitcoin strategic reserve with a government is being discussed, or like bit bonds, like Bitcoin even serving as a sort of collateral for US government debt, But I mean, in history, as far as I was informed and I researched it, it feels like this has been the case in some point in time, or at least what I researched is even that before 1922 or something, US treasuries were even not allowed to be sort of backed, quote unquote, by US treasury, or treasury. The currency was not allowed to be sort of backed by US treasury debt. There was like these real bills, so more sort of commercial paper that was more extensively used and stuff like this. And so I feel like we have the precedent for this, that we could go down this route again and have the dollar be stabilized by something other than treasury bonds only, I guess. Right?
Yeah, we absolutely could. The question is, where is the incentive there? Do any of the people that run the system want to do it? And then even the voters, if they say they want to do it, but then it's like, well, okay, so we're going to do austerity now, and your Social Security checks are going to get clipped. And like, well, no, I don't want that. I just want the good side, not the downside. I don't want anything to happen to me. And so between the voters and the politicians, the fiat currency debasement is kind of the release valve. So as they fail to agree with each other on how much to tax, how much to spend, the error just gets kind of invisibly debased and argued over, and kind of the impacts happen with a delay. So I think nothing short of a forcing function is needed, which is basically, it's going to keep happening until something forces them otherwise. Which is to say, until there's something really powerful in their face, like Bitcoin is 10 times bigger than it is now or something, they're going to keep doing it.
Obviously, bonds are also traditionally viewed as a safe haven in times of war and just turbulence and stuff, and I think you just recently posted that with this last sort of hiccup that we've seen, like the strength wasn't particularly great, in terms of like money flocking into government bonds. And I know you're not a doomer or a crash prophet. And so, I mean, how do you put this into perspective? It's probably not the final call, but we're seeing just like incrementally probably things chipping away at this monetary status and reserve status or asset status of these treasuries. So how do you put this into perspective?
So I would say that bonds have been a kind of safe haven for a shorter period of time than people think. So if you go back, for example, from the 1930s all the way through the 1970s, bonds were like one of the worst things you could possibly invest in. Almost anything else is better than bonds and currency. It was like a structural, like a generational long bear market in bonds. And sure, during brief recessions, in some cases they would do well, but other times they wouldn't. It'd be like an inflationary recession. And then from the 1980s through the 2010s, they took on this safe haven aspect. And that's the operating history for most investors today. So in current investing lifetimes, they view U.S. And other kind of developed government bonds as safe havens, which is long in the sense that it's, like a 60-year-old or 70-year-old investment manager today. It's been throughout their entire career, but it's not really before that. And so, we grew up with it, or we operated with it. And that regime can change. And I would argue that it already has, because I generally argue that we're back in an environment that looks more like the 1940s. I think we're starting another cycle where bonds and currency are just not defensive assets. They're more in the structural debasement period. From the 1980s, from that point, we had already, the bond bear market was so bad, they already got most of the purchasing power wiped out. And then we kind of reset with a very low debt level at the sovereign level, and to some extent the private level. So low debt, they were able to, in the 80s, run a very hard monetary policy, at least as far as fiat currency goes. And that kind of started the next bull market in bonds. But we've spent 40 years tapping into that, and now we're back into a state of high debt, which is generally a period of time where bonds and currency are not going to do well. And I mean, I wrote an article in 2019. Are we in a bond bubble? And kind of analyzed the whole thing and decided yes, we are. And it's been like the worst 5-year period for bonds, like, in history. Like, it's been catastrophic for bonds versus every other asset that you could almost possibly own. And I don't think it's maybe going to be as bad, say, the next 5 years as those 5 years. Like, that was like unusually bad. But much like the 40s or the kind of the late 30s through the 70s, I think we're in a more structural period of just bond just not being great anymore.
Because, like, another way where I could see this sort of not being money printing, sort of, but maybe having this stimulative effects would be if you were sort of retiring bonds and now reissuing them with a higher interest rate, because, like, interest rates have maybe also moved. And then obviously the newer bonds that sort of come online would have a higher interest rate. And that would then, I think you alluded to this as well already, through this interest rate MMT channel, like more money would end up in the economy because the government would have to pay now higher interest rates on these new bonds. I mean, that's probably not their goal, but I mean, if interest rates are higher and they sort of have to do this, by buying them back, but then issuing at a higher interest rate, then that would also have sort of a stimulative effect, wouldn't it?
Yeah, to some extent. Yeah, absolutely. And that's actually one of the issues where, because we're no longer in a structurally declining interest rate, things start working differently than investors have been used to for their entire investing career. 40 plus years of structurally declining interest rates are over now. And so even if they're not going structurally up, if they're just going structurally sideways, we're in a new environment. And so it's not like, it used to be that basically all new issued bonds had lower interest rates than older bonds, and we're not in that environment anymore. Now, the amount of buybacks that they're doing relative to total debt, I would say, are not moving the needle a ton on total interest rate compared to just the amount that's outstanding. If you're doing tens of billions of buybacks and there's tens of trillions of debt outstanding, it's not like you're meaningfully changing the interest rate profile, which is why I think that overall this topic currently gets more attention than it probably deserves compared to other things that are happening. Not to say that it's irrelevant, but yeah, that's certainly a factor.